Inflation continued to abate in December 2013. Annual headline inflation declined 6.7% in December 2013 from 6.8% in the previous month, reflecting mainly the decrease in transport and communication and beverages and tobacco. Annual core inflation declined to 5.7% from 7% in November 2013. Annual non-food inflation also declined to 5.7% from 6.3% in November 2013. Annual food inflation, however, rose 9.2% from 8.1%. The increase in food inflation was largely driven by relatively low food prices in December 2012, as monthly food inflation stood at -1%. The Bank of Uganda forecasts suggests that inflation will edge down further in the near term, driven by improved food crop harvests, but will rise to 6.5 to 7.5% during the latter part of 2014. The potential rise in inflation and its timing will depend largely on movements in the exchange rate, changes in commodity prices, and the degree to which momentum in economic activity spills over into broader cost and price measures. The degree to which momentum in economic activity spills over into broader cost and price pressures, not measures. Growth in the first quarter of 2013-2014 was lower than expected, as quarterly GDP declined by 0.6% compared to the previous quarter. This decline was precipitated by a drought, which led to a 3.4% decline in agricultural output. Nonetheless, the economy is projected to pick up in the remaining part of 2013-2014, driven largely by recovery in agricultural production and public investment in infrastructure, which could enhance competitiveness in the short to medium term. Private consumption and investment activity is expected to rise as consumer and household credit extension gradually gain momentum following the declines in commercial banks' lending rates. Growth in 2013-2014 is still projected to be between 6% and 6.5%, which is well within the level of potential GDP growth. In spite of better than expected October 2013, December 2013 inflation outcome, the Bank of Uganda will continue to assess the risks to the inflation outlook to be on the upside. Monetary policy, therefore, has to balance current modest inflation outturn against the likelihood that inflation pressures will rise over the medium term. Therefore, the Bank of Uganda will maintain the central bank rate at 11.5% in January 2014. The band on the CBR will be maintained at plus or minus 2 percentage points, and the margin on the rediscount rate will be at 3 percentage points on the CBR. Consequently, the rediscount rate and the bank rate for January 2013 will be 14.5% and 15.5% respectively. The Bank of Uganda will continue to assess the global and domestic economic developments and their implications on the overall outlook for inflation and growth of the Ugandan economy. The bank shall take appropriate action to ensure that annual core inflation remains around the target of 5% in the medium term.